Hi, I'm Amy Irvine, the owner and founder of Rooted Planning Group. Welcome to this month's edition of Rooted Planning Group's monthly chart book. Over the past month, markets certainly have remained uncertain due to inflation, the Fed, tech stocks, and more. For long-term investors, it's always important to remain in the proper perspective and look past short-term volatility. As you can see by this chart, the current year-to-date performance is 14.4% as of the end of last month, which was November 30th. At the lowest point this year, the S&P 500 was down 25%. One of the key things that we monitor is the stock market moving averages. What you're looking at here is the S&P 500's 50, 100, and 200-day moving averages. One thing that we look at is the direction of the momentum of that moving average. Notice how this is somewhat evened out, I would say, although not completely. But at the end, things are starting to tip upwards. That could mean that the moving average, once it crosses over, is a sort of technical signal that the market could be continuing to move upward. Now, I used a lot of could, maybes, and possibles in there. In one of my previous presentations, I talked about the stock market price to earnings ratio. It did touch close to the historical average. It has since moved back up since that period of time. So stocks were cheaper at the point that it was closer to that historical average and have indeed moved up since that. Well, that makes sense because you just saw the report that showed that the market has recovered. And when I'm saying the market, I'm specifically talking about the S&P 500 has recovered since its lowest point. A quick update as to where we're at. For those of you that have seen these before, you'll know that the blue bars are the year-to-date performance numbers. So if you bought January 1st and you held on until December 31st for each of the years since 1980. The red dots are the pullbacks or the intra-year pullbacks that happened within the S&P 500 in any of those given years. Notice how in 2002, this 25% was the biggest drawdown that happened in the portfolio, and it actually, or in the S&P 500, and it actually happened twice. So it hit that, recovered, and then hit that again, and has since somewhat recovered. Although year to date is still down about 14.4%, as I mentioned earlier. Also, for those that may have seen these presentations in the past, just to reiterate, generally market corrections and recoveries, and this chart just talks about since World War II, take about 5 months on average to get to the trough, so from peak to trough, and the average correction is about 14.3%. Well, the average recovery from trough to peak, again, so basically recovery is what we're talking about, takes about 4 months. This is not to say that we're in an average market recovery or market correction, but it's to give some idea of what historically has happened in the past. Then when we talk about bear markets and recoveries, when you look at the average bear market, it falls 34%. And typically when we're looking at a bear market, remember it's 20% or worse, which we had happen this year. And it takes about a year and a half to get to that bottom. So from peak to trough, it's a little bit longer, where the recovery takes about 2 years and 5 months. Again, this is historical since World War II. I don't know that we're in this, or if we're in just a correction, or if we're going to be anywhere near. The law of averages is just that, the law of averages. But it does give people some understanding of what typically happens. That being said, there is an importance of staying invested. As you can see, if you stay fully invested, if we look past the 25 past years and you stayed fully invested in all of the market up and down, so you invested $1,000 25 years ago and you left it there, you never pulled it out, you never added to it, you never did anything, that $1,000 would be worth about $4,200. If you missed the best day in that period of time, it'd be worth about $3,700 say 3,800 if you round up. If, however, you did the classic move of I'm going to pull out and I'm going to wait until the market recovers and then put the money back in, so you missed the best 40 days, then that same value would be worth about $484. This is why we tell people to sit and wait, and if possible, buy into these down markets. This is no guarantee that it will happen, but this has been the historical trend. One other area that I like to update people on is interest rates. We're still in a inverse yield curve, meaning the 2-year yield curve is greater, or the 2-year yield is greater than the longer term. So right now we're looking at a 2-year yield of 4.38 versus a 10-year. You've noticed if you held bond funds this year that bond prices have gone down, and that's typical. Bond prices go down when interest rates go up. So right now we're still in an inverted yield curve, and shorter durations are still our preference. I also wanted to mention to you some of the leading economic indicators. So this is the Conference Board leading economic indicator year over year. What this is showing is that recessions are shaded, so they're a shaded area. Right now, we're not technically in a recession, but you can see that the indicator turns negative several months before a recession, and the indicator has indeed turned negative. Another big area that we look at is consumer spending. You'll notice that both retail sales and non-store sales have dropped, and when consumer spending drops, that's another important way to measure overall the health of our economy. And so again, this just goes along with the same bit of information that is indicating our economy is slowing down. Another indication is building permits. That's been a big drop. We've seen a huge drop in building permits and existing home sales. Notice how much existing home sales has dropped. That's a big decline. Even since late 2001, we've seen a very large decline in the average being about 5,511. You can see that the latest numbers are showing definitely we're slowing down when it comes to existing home sales. Real quick, one other area that we like to look at is the annual returns. Notice that this year annual returns for both the S&P 500 and the U.S. aggregate bond funds are in negative territory. It's unusual if you look back historically to see both of these in negative territory at the same time. So if you're looking back to 1990, notice that this is the only year that has both the stock market, meaning the S&P 500, and the bond market in negative territory. One thing that I always like to mention about bonds is that the price will revert to its original face value. So when bonds mature, they mature at the face value. So for example, if you bought a $1,000 US government bond, that's the face value. So one bond would be $1,000. And the price has pulled back because of rising interest rates. When that bond matures, you will get your $1,000 back. It might only be worth right now about 86% or $8,600, but it's going to, unless it's a high yield bond that goes into default, which we don't have in our portfolio at this time, then that's what's going to happen with bonds. And I just like to explain that to people so they understand. And I always joke and say that good diversification always means having to apologize for something. You'll notice that this year, if you're in a balanced portfolio defined by 60% equities, 40% bonds, other than commodities, which have come down from their peak, the balanced fund does have the best performance, although negative, does have the best performance so far this year. Wrapping up our talk on overall economic indicators, the US dollar is still very strong compared to the yen, euro, the Great Britain, and the Great Britain pound, excuse me. If you hold international positions in your portfolio, which most of our clients do, you'll notice that international holdings have performed quite well. And that has to do with the fact that the dollar is so strong right now. Another indicator that we look at and we share with you is the personal savings rate. Notice how much that has dropped also in the past year and past few months. That's why we have been saying all summer long that yes, it's the economy is still hot, but it's hot at the cost of personal savings. And you can certainly see that that is true right now. We hope that you have enjoyed this particular edition of our chart book. If you have any questions or concerns or would like us to explore areas further in the future, please reach out to us and let us know. We appreciate you spending your time listening to us.